While everyone's attention is on inflation, interest rates, and the ups and downs of the stock market, a hidden financial crisis is quietly assembling itself, piece by piece. It's scheduled to strike the American banking system in 2026. This isn't just speculation. This is a documented fact based on Federal Reserve data and banking industry reports. This crisis has a name: the maturity wall. We're about to show you exactly how this collapse is poised to trigger the most devastating financial shock since the Great Depression. To understand what's coming, we need to look back at what happened to New York Community Bank in February 2024. Almost overnight, the bank announced massive losses on its commercial real estate loans, and its stock price completely collapsed. Now, this bank wasn't an outlier. It was typical of thousands of regional banks all across America. What destroyed it is the single largest threat to the American banking system since the subprime mortgage crisis: its exposure to commercial real estate, or CRE. Here are the numbers that should terrify you. 1,788 banks have commercial real estate exposures greater than 300% of their total equity capital. Let that sink in. If just 30% of those CRE loans go bad, these banks are instantly wiped out. And the situation is actually worse. Because of remote work and much higher interest rates, 44% of all office building loans are already in negative equity. The focal point for all this is the year 2026. Over the next 2 years, more than $1 trillion in CRE loans are coming due for repayment or refinancing. These loans were originally written when interest rates were near zero. Now, they must be refinanced at rates that are 3 times higher. For properties that are worth maybe half as much as they were, the math is simple and brutal. Right now, banks are playing a game of extend and pretend, just kicking the can down the road, but that road comes to a dead end in 2026. Top investors are predicting between 500 to 1,000 bank failures in 2025 and 2026. That's more than one bank failing every single day. But here's the real catastrophe: the FDIC's Deposit Insurance Fund, the money set aside to protect your deposits, represents only about 0.5% of the entire banking system's assets. What happens when the FDIC runs out of money? What happens when the very agency responsible for maintaining confidence in the system can't fulfill its most basic function? The answer is a crisis of confidence that could make 2008 look like a minor market correction. And CRE is only one piece of the puzzle. The second bomb is what's known as unrealized bond losses, which shot up to $483 billion in late 2024. Here's how it works. When interest rates go up, the value of the bonds that banks already own goes down. As long as they hold onto them, the loss is just on paper. But as banks start facing deposit outflows due to the CRE crisis, they are forced to sell these underwater bonds for cash. The moment they sell, they instantly realize those massive losses. This is the exact trigger that caused the bank run that destroyed Silicon Valley Bank in just 48 hours. Now, let's talk about a threat that didn't even exist back in 2008, the shadow banking system. It now holds an astounding $68 trillion in assets that's more than 3 times the size of the entire U.S. economy. This system operates with virtually no government oversight, yet it is intimately connected to traditional banks through over $1 trillion in lending. When a crisis hits this unregulated shadow system, like in the private credit markets, the contagion will ripple catastrophically into the traditional banks that finance it. Regulators themselves are describing a potential financial contagion that would make the 2008 crisis look contained. So, what about the solution? Well, the tools are limited. Unlike 2008, when the Fed could slash interest rates from over 5% down to near zero, today's rates are already high, and inflation won't go away. The government's financial position is equally tight, with federal debt approaching 130% of GDP. Their ability to roll out massive bailouts is severely limited and even risks triggering a crisis of confidence in the dollar itself. In a modern crisis, Speed is everything. Remember, Silicon Valley Bank collapsed in just 48 hours. In our digital world, bank runs are instantaneous and massive. The sequence of events is clear. First comes loss recognition in 2025. This leads to a confidence crisis in 2026, which then causes a liquidity crisis. The final stage is systemic contagion. This crisis isn't a possibility, it is a mathematical certainty. The only question now is, what are you going to do about it before the dominoes start falling in 2026? Knowledge is power. You now know what the smart money has known for months. In our next video, we will reveal the concrete steps you must take to protect your money and your savings from the consequences of this imminent financial earthquake. Subscribe now, because the window for protection is closing fast. Thanks for watching.